Module Overview. Module 3 delves into the fundamental principles, economic theories, and valuation doctrines that provide the theoretical framework upon which all valuation activities are based. The module integrates classical and modern valuation paradigms drawn from economics, real estate theory, finance, and urban planning, and applies them to the diverse contexts in which property valuation is carried out. Understanding these principles enables valuers to make objective, defensible, and logical decisions when estimating value, selecting valuation methods, making adjustments, or advising stakeholders. These principles also form the philosophical bedrock for standard valuation practice globally. 1. The nature of value and the concept of worth. Value, in the context of property, refers to the monetary worth of an asset as determined by market forces, usage, and legal rights at a specific point in time. While often used interchangeably, value, worth, and price have distinct meanings. Value: estimated amount a willing buyer will pay to a willing seller, under defined assumptions. Worth: subjective to the buyer's unique preferences or motivations. Price: actual transaction amount, may not represent true market value. The distinction is critical when preparing reports for sale, litigation, taxation, or compulsory acquisition. 2 core principles of valuation. There are foundational principles that guide every appraisal. These principles serve as benchmarks for analyzing the behavior of real estate assets in the market. First principle of supply and demand. This dictates that value is affected by the availability of property, supply, and the desire and ability of buyers to purchase, demand. Scarcity increases value, while oversupply depresses it. Second principle of substitution states that a rational buyer will not pay more for a property than the cost of acquiring a similar, equally desirable substitute. This is the backbone of the comparative approach. Third principle of highest and best use, HBU. As emphasized earlier, property should be appraised based on its most productive legal and feasible use, whether or not that use is current. Fourth principle of contribution. A component's value is determined not in isolation, but based on its contribution to the overall value of the property. For instance, a swimming pool may add no value in a low-income area. Fifth principle of change value is dynamic and influenced by physical, economic, political, and environmental changes. Factors such as infrastructure development or zoning changes impact property value over time. Sixth principle of conformity. Property value tends to be optimized when it conforms to the prevailing land use or architectural style of the area. Deviation reduces market appeal and value. Seventh, principle of regression and progression. Regression. Superior properties tend to lose value when surrounded by inferior properties. Progression. Inferior properties gain value when located near superior ones. 3 economic theories relevant to valuation. Real estate valuation is grounded in several economic theories that explain how value is formed and interpreted in the marketplace. 1. Theory of utility. A property must satisfy a need or provide a service to hold value. A beautiful house in an inaccessible jungle has little utility. Second, theory of marginal productivity. Used in land and development, valuation value is added only when the output exceeds the input cost, e.g., building. A fourth story may not always be profitable. Third, theory of anticipation value is based not just on current benefits, but the expected future income or benefits the property will generate. Central to income capitalization method. Fourth, theory of balance. Optimum value occurs when there's equilibrium between land, labor, capital, and entrepreneurship, the 4 agents of production. 4 market value versus other types of value. Market value. The most probable price obtainable under open market conditions between a willing buyer and a willing seller without duress. Investment value. The value of the property to a specific investor based on their expectations, risk appetite, and investment strategy. Insurable value. The replacement cost of a property for insurance purposes, often excluding land value. Assessed value assigned by a tax authority for the purpose of computing property tax. Fair value, a measurement used in financial reporting, consistent with IFRS standards. 5. The valuer as an interpreter of value. A professional valuer does not create value, but interprets market data to estimate value under certain assumptions. They must understand economic signals, analyze historical data and trends, forecast demand, consider risks and obsolescence. This analytical role positions valuers at the nexus of data interpretation, professional judgment, and market knowledge. 6. Principles of professional conduct and ethics. Valuers must apply these principles objectively and ethically, without bias, conflict of interest, or external influence. Violation of principles such as independence, integrity, and competence results in disciplinary action and loss of professional standing. Key takeaways. Valuation is based on core economic and valuation principles. Principles like substitution, contribution, and conformity underpin every valuation method. Understanding theories such as anticipation and marginal productivity is critical for investment valuation. Market value is not universal. Other value types exist for specific purposes. A valuer must use professional judgment backed by theory and data.